The crypto market is not a casino, despite what you've heard. It's a business ledger, and once you learn how to read it, you can stop guessing and start investing. Today I'll show you the one metric I use to find real winners, while many are still chasing pure hype. Most people believe that crypto valuation is nothing but speculation, like a digital gamble based on hype and influencer narratives. But that's only a part of the story. The truth is, there are crypto protocols that are real businesses with real revenue, and the blockchain gives us the tools to measure it. Welcome to Sovereign Stash. I'm Anna, ex-product manager turned full-time crypto investor and creator of the Sovereign Stash strategy. And in this video, I'm going to show you a framework for valuing crypto projects based on their financial fundamentals, just like you would a traditional company, and how even beginners can apply it to make smarter bets. To do this, we're going to be looking at a dashboard from Dune Analytics. I'll put the link to this dashboard in the description. Now, Dune is a public platform where analysts share incredible dashboards built on raw on-chain data. The specific one we're using today is called Cash Cows, built by a very helpful analyst named Do Your Own Research Crypto, DYOR Crypto. I know a dashboard like this can look intimidating and data heavy at first, but do not worry. I am going to break it down so simply that anyone can understand it. My goal is to show you how to read this powerful tool to find your own investment insights. So we're going to cover three things. First, why focusing on a protocol's revenue is the only way to begin. Second, I'll show you the single most important metric on this dashboard, a crypto PE ratio, to see if a project is cheap or expensive. And third, I'll show you an advanced technique for spotting new trends to find opportunities as they develop. But just quickly, if you want more crypto tactics after this video, I have a free 5-day email course aimed at beginners called Crypto Survival 101. The link's right there in the description. Let's get into it. To become a strategic crypto investor, we have to shift our focus from just price charts to protocol revenue. Think about it like a traditional business. Would you invest in a company without knowing if it makes any money? Of course not. You'd look at its sales, its revenue, its earnings, its products, its market. In crypto, a protocol's sales, if you like, are the fees it generates. Whether it's a decentralized exchange, a lending platform, or a blockchain, if it provides a service people are willing to pay for, it generates fees. That fee revenue is the clearest signal of product market fit. It's real on-chain data that can tell you that the project is providing genuine value. Focusing on revenue instead of narrative is the foundational mindset shift from being a speculator to being an investor. And if this is the kind of strategic thinking you're looking for, take a second to hit the like and subscribe button below. It tells YouTube that this kind of content is valuable to you. But knowing a project makes money isn't enough. The key is also knowing if you're paying a fair price for those earnings. Remember, like any market, some protocols can goose their activity at times, so always sanity check the numbers if something looks off. Now, this brings us to the metrics on the dashboard. Before we dive in, you need to understand a critical distinction between two terms, fees and revenue. Total fees are the gross sales. It's the total amount users pay to use the protocol. Protocol revenue is the net income. It's the portion of those fees that actually goes to the protocol's treasury or its token holders. Think of it like a McDonald's franchise. The total fees are all the money customers pay for burgers. The protocol revenue is the profit McDonald's Corporation gets after costs. Okay, with that key distinction in mind, let's continue. This particular dashboard's primary metric is the FDV to annualized fee ratio. Let's break that down. It's a kind of crypto PE ratio. In traditional finance, the price to earnings or PE ratio tells you how expensive a stock is relative to its profits. This metric here does the exact same thing for a crypto protocol. FDV, or fully diluted valuation, is the total value of a crypto project if all of its tokens were in circulation at the current market price, i.e. what the entire network would be worth if every token already existed. It takes the token's total valuation and divides it by the annualized fees the protocol generates. This metric answers the question, how many years would it take for this protocol's fee revenue to equal its current valuation? A low number suggests the project might be cheap or undervalued relative to the cash it's generating. A high number suggests it's expensive. This simple ratio is the primary tool that allows you to cut through the hype and compare vastly different projects on a level financial playing field. It allows you to ask, is this asset fairly priced? Okay, let's make this real. Let's take a look at a project called Fluid, which is in the DEX or lending category. Fluid provides liquid staking derivatives that let you earn staking rewards while keeping your tokens liquid for DeFi. We can see its fully diluted valuation, or FDV, is around 360 million. And we can see its annualized fee revenue is about 4.4 million. So, to get our ratio, we just divide the valuation by the fees. That gives us a crypto PE ratio of roughly 82. The table does the calculation for us, of course. Is that good or bad? By itself, it's just a number. But now you can compare it to other projects in the same category to see if it's relatively cheap or expensive. This is the power of the tool. Finding a cheap project is powerful, but what's even more powerful is finding one that is getting cheaper by the day. This is where we add the final strategic layer. We don't just look at the ratio today, we look at how it's changing over time. The FDV to fees ratio change percentage shows you exactly that. It tells you if a project is getting more or less expensive relative to its earnings. A positive percentage means the valuation is growing faster than the fees. The token is becoming more expensive. But a negative percentage, that's often a signal of opportunity. It can mean the token's price has dropped, while its fee revenue has stayed strong or even grown. The business is still performing well, but the market is offering you a better price for it. This is how you move from static analysis to dynamic analysis. You're not just finding value, you're spotting developing trends and potential entry points based on data that's not just price action. Now let's look at CRV or Curve to see this in action as well. Curve is a decentralized exchange, or DEX, optimized for stablecoin trading. We can see here that over the last 365 days, Curve's PE ratio has changed by positive 200%. A positive number means the token has become more expensive relative to its revenue over the last 12 months, and valuation has outpaced the growth in fees. This doesn't mean it's a bad investment, it just means you're no longer early to this specific re-rating. The market has already recognized its value and priced it higher. A strategist might see this and decide to look for other projects with a negative percentage, where the valuation is getting cheaper, signaling a potential opportunity. This is how you use data to make informed decisions. Let's look at Jupiter, or Jupe. Jupiter is a Solana DEX aggregator, and it has what's called lumpy fees. Lumpy fees means the protocol's income isn't smooth. Revenue comes in big bursts, for example during a market spike or incentives week, instead of a predictable daily trickle. So one snapshot can look deceptively high or low. We can see here that over the last 30 days, Jupe's ratio has changed by negative 10% roughly. But if we look at the 1 year change, it's a negative 69%. This tells a story. It suggests that while there has been recent positive price movement, on a longer term time frame, the token is still fundamentally cheaper relative to its earnings than it was a year ago. This is the kind of data that helps you ask better questions. Has something fundamentally improved in the last month, or is the long-term trend more significant? This is how you use data to build a thesis. Now, this is just one framework. There are many other crypto selection techniques to building a resilient crypto portfolio. That's one of the reasons why I created the Crypto Survival 101 email course. It's a free 5-day resource to give you some foundational knowledge and framework. It's aimed at beginners, and the link's in the description. So let's recap. First, you shifted your mindset to focus on protocol revenue, not just price. Second, you've learned how to use a crypto PE ratio to assess if a project is fairly valued. And third, you can now analyze the trend to see if that valuation is becoming more or less attractive over time. You now have a professional grade framework for crypto valuation. You are no longer just guessing. You are operating with a clear sovereign stash strategy. Remember, this is not financial advice, it's technically financial entertainment. So always do your own research and design your own strategies. If this video helped clarify a path to smarter investing, I'd appreciate it if you hit that like button and subscribe for more if you haven't already, and share this video with someone who might also like it. If you want to dig deeper into crypto, I've linked some great books in the description. They cover topics like crypto fundamentals, revenue metrics, and how to think beyond price charts. In the video description, you'll also find links to other key resources and tools I use for my own crypto strategy. Now, if you enjoyed this, I think you'll also like this next video. Thanks for watching. See you in the next one.